Hello, my name is Joe Hoyle, speaking to you from the University of Richmond here in Richmond, Virginia. We have an interesting question today. This is the first video in this chapter, and they pose a very interesting question. What does a CPA, what does a public accountant add to all of this process? You may have heard of CPAs, you know they get paid fairly well. What role do they actually play? Well, there's a very fascinating question that we have to address. We already know that financial statements are produced so that outside decision makers can decide whether to buy stock, make loans, go to work for a company, make important decisions. The question is, if those financial statements are produced by the company itself, why should any outsider trust them? I mean, if you're looking at a company and they produce the financial statements, why would you trust them with your money? Well, the answer is a lot of people wouldn't. And therefore, the system wouldn't work. Even if the company was very, very honest, there's always the concern by the outside decision maker about whether they can trust what they're seeing. So in some way, this entire system does not work unless we add credibility, unless we add trust. So the system works in this way. The parents of your roommate own an ice cream store, and they produce financial statements. Why does the bank, why would other owners trust those statements? The reason is that the parents, the owners, hire a public accountant, a certified public accountant, a CPA, to come in and to look at those financial statements and make certain that they are presented fairly according to U.S. GAAP. So what is the role of the CPA? The CPA visits the company, and the CPA takes the financial statements that the company has already produced itself, and the CPA gathers the information, gathers evidence to make sure that those financial statements are indeed presented fairly. Now what happens is that the CPA is looking to see if there's any material misstatements in those financial statements. Now we know from previous chapters that a misstatement is something wrong. It's either an error, which is an accidental mistake, or fraud, which is an intentional mistake. So the CPA is looking for any misstatement, either an error or fraud, and it needs to be, before the CPA is going to worry, it needs to be material. And material is anything of a size or type that would change a decision maker's decision. In other words, material means that it's big enough or problematic enough that the decision maker would be impacted. So the CPA goes through all of the information that's being presented and gathers evidence about that information. And eventually the CPA will be satisfied, what we say, reasonably assured, that the information being presented by the roommate's parents' company contains no material misstatements according to U.S. GAAP, and therefore is presented fairly. No material misstatements. At that point, the CPA will produce a report. And that report basically says, I know it says a lot more than this, but what that statement really says is, you can use this financial information to make your decisions about this company. So when you go out and you look at a company's financial statements, always look to see if the CPA has provided a report and to see if the CPA has given what's called an unqualified opinion. And that unqualified opinion means you can trust the information that is being provided. So what does the CPA actually add? The CPA adds credibility to the whole process. If there was not a CPA it's not likely that decision makers would trust those financial statements enough to be willing to risk their money. So we in the CPA profession like to say that we're the reason that people are willing to risk their money to make the businesses grow and prosper. CPAs help our society and help our industries become growing, prosperous companies. This is Joe Hoyle. I'm at the University of Richmond. I'm hoping that you're having a great semester and that you're really enjoying and maybe appreciating the importance of what you're learning in financial accounting.